Good morning, listeners. This is your host Parthesh Shah, co-founder of Fintech, and you are listening to Night Snippets. Here is all what you need to know before going into trade for 17th September 2020. In the international market, the Fed policy statement said the central bank would keep interest rates near zero until inflation overshoot 2% for a sustained period and the US hit maximum employment. The Fed's so-called dot plot of likely interest rates showed that most official anticipates rates will remain near zero until the end of 2023. After the statement, long-term treasury yields rose faster than the shorter-term papers, steepening the yield curve. With Fed comments, the US 10-year benchmark closed 1 basis points higher at 0.69 percentage points. In the crude oil market, as we mentioned in the podcast yesterday, that API reported a record draw in crude oil inventories. The crude prices had a small rally. Crude is back to $42.15 per barrel. Our advice, we have squared off our crude short positions yesterday itself and is now flat on crude. But in a long run, with 3 to 6 month perspective, we are way bullish on crude oil prices. In the currency market, DXY or dollar index is back to 93.33 levels. As we know, the dollar has been trading in the 93 to 93.5 range for quite some time now. USDINR or Chinese yuan targets are met. We were expecting 675 levels and it was achieved yesterday itself. USDINR closed below 73.55's critical hurdle. There is a growing tension between India-China border and US dollar rebound yesterday. Hence our advice would be to book profits if any and do not wait for 73 levels. In the domestic market, government bonds rose sharply yesterday as comments by RBI Governor Shaktikanta Das on economy and the central bank's willingness to support the economy-led participants believe that RBI is likely to remain accommodative. Center is likely to detail its October-March borrowing towards the end of September. Until then and onwards also, the RBI is likely to announce more rounds of special OMOs along with other measures to anchor the bond yields. For now, it seems 590 to 6% range is something RBI is very comfortable with, but expected higher borrowings by center and states will put pressure on yields as the incremental borrowing amount can exceed up to 2.4 lakh crore, much higher than anticipated. Our night's advice: continue to hold 522 GS 2025 position which you had created above 550 levels. Current level is 536 and a short momentum will continue for a day or two.